Welcome to the Why Not Real Estate Podcast, where you will learn top strategies from world-class real estate investors, both large and small. Why not? Tune in and get started today.
The 1031 exchange opportunities I provide my clients are very unique. It's definitely a niche business. They are DSTs, Delaware Statutory Trusts, right? So 1031 exchange is in the tax code, right? It allows you to defer taxes selling and replacing an investment property. The DST is a structure or vehicle that satisfies a 1031. So the Delaware Statutory Trust, they were created in the 80s. They weren't set up for 1031 purposes at that time, but it's a structure or an entity or trust where you have one trustee that manages the trust on behalf of up to 499 beneficial owners, right? So you apply this trust to real estate, it creates a situation where fractionalized ownership. So you can have a lot of investors come in and invest, own undivided interest in the trust that owns XYZ properties, and it's still treated as real property ownership. So in 2004, this fractionalized ownership structure was validated by the IRS. They said, yes, this is real property. This is considered real property, and therefore eligible to satisfy 1031 exchanges. Right. So 2004, that's when the DSTs were born. Right. And they've grown in popularity ever since.
Hey, what's up, all of my real estate peeps? This is Brian Lucier with another episode of the Why Not Real Estate Podcast, where we interviewed seasoned and not so seasoned real estate investors, where we believe investing in multifamily is the best investment class, although I have been proven wrong on a few shows. So let's get into today's show. Our special guest today is one of the managing partners at Perch Wealth. With more than 20 years of applied experience, he is an expert in 1031 exchanges, Delaware Statutory Trusts, real estate investment structures, and strategies. During his tenure at some of the most prominent industry-leading investment management firms, including Cantor Fitzgerald, NexPoint Advisors, and Capital Square Advisors, he's been involved in acquisitions, finance, due diligence, underwriting, product structuring, syndication, and sales management. Through his experience, he's developed a comprehensive understanding of alternative investments and financial services industries with deep knowledge and expertise in structured 1031 products such as tenancy in commons, commonly known as a TIC, Delaware Statutory Trusts, DSTs, non-listed real estate investment trusts, REITs, non-listed business development companies, BDCs, private equity and debt funds, interval funds, and other private placement syndications. Boy, he's got quite the toolbox and tool belt he's wearing. His various executive roles and work within the financial services industry have helped hone his business instincts and acumen. His career has led him to become uniquely qualified to provide guidance on how products are structured and operated. His insight, along with his ability to uncover key variables that play a significant part in the probability of success for a particular investment, is critical to meeting his clients' financial goals. Our guest holds a Bachelor of Arts, BA degree in finance, real estate from San Francisco, from San Diego State University, as well as Financial Industry Regulatory Authority, FINRA, Series 7, 24, and 63 licenses. Ladies and gentlemen, all of our real estate peeps, it is my pleasure to welcome to the show today managing partner at Perch Wealth, Mr. Benjamin Carmona. Ben, welcome to the show.
It's an amazing introduction. Thank you, Brian. Great to be here. Thanks for having me.
I get that a lot when I finish up. People say, wow, that was an amazing introduction. But all I'm doing is holding up a mirror to your story. So I guess you have an amazing story. And I'm really excited to have you here. I mean, I was looking through the laundry list of the different things we could probably touch on today. And it's a couple days after Christmas that we're shooting this, and I feel like it's Christmas all over again. So really excited. And if I don't remember to ask you, I really, really would love later when we get into some of this for you to connect the dots between a Delaware Statutory Trust, and the 1031 exchange and how those
Sure.
dovetail together. That I think is going to be a real highlight, pivotal for this show. So you've got the questions. I've got a series of questions to ask you. And if it's okay with you, let's
Yeah,
get started.
let's shoot. Let's go. Thank you.
All right. So I've read a little bit about your background, done a little bit snooping around on you on the internet. But for our listeners, could you tell us a little bit about your background and what you used to do before becoming a real estate investor?
Well, it was. I jumped right into it. Before, right out of college, even before college. I mean, I grew up in a family that was in real estate and foreclosures and lending. So it's always kind of been in my DNA. So prior to getting into the business, or a little bit about myself, I guess, I live in Southern California, Orange County. I've been married for almost 12 years now. I have two amazing young children, a 7-year-old son and a 5-year-old daughter. Love sports, played soccer almost, all my life, and I still play today to some extent. So I don't know if that was a question, Brian. That's a little bit about me, but I mean, in terms of real estate and investing, what was I doing before? Nothing. I mean, this is always what I've done.
So you mentioned you had family influences. What type of influences? And I always love this part of it because I'm sure the conversations you and your family had at the dinner table were not the normal average conversations most families have at the dinner table.
Right,
So
right.
what kind of real estate was your family into that kind of piqued your interest when you were younger?
Sure. Yeah, again, I mean, my parents owned not a lot, but they owned a handful of multifamily properties, in Los Angeles. They still do. My dad's a private lender. He owned a foreclosure company. So I was always, I'd go out and 8 years old, I'd be driving, doing what BPO's brokers price opinions with my dad, and going back to the office and just, I was very, that's what got me going. I mean, and he really got me involved in all aspects. I mean, appreciating money, right? Um, Respecting the dollar, and investing.
So at 8 years old, the light bulb was turned on to you. And I mean, you probably grew up just thinking this is what normal people do or what's normal. You
Yeah.
mentioned college. So what was your study in college?
Real estate, or finance with emphasis in real estate. It's funny. You go to college, and how many times do you hear parents, or how many of my friends who ask them, "What are you going to do? What do you want to do?" I don't know. I don't know. Like, I knew what I wanted to do. I didn't know I was going to end up in this kind of a niche market, the private real estate syndication side of the business. But I always, I still have a great passion for what I do.
So you woke up with the crayons that had real estate all over them, and you just colored in the lines, and here you are. So you went to college, focused on real estate. You got out of got out of college.
Right.
What was that first landing on your feet doing real estate out of college?
Yeah. Well, it's funny, your listeners probably don't care, but I thought I was going to walk out of school and that people were just going to be handing me applications left and right, and that's not the case. And that was a tough time for 3 months. I went into a small depression, but I ended up, through a friend of a friend or so, I was introduced to to the company was Triple Net Properties at the time. And I wanted to be on the acquisition side. I wanted to be an analyst. But I ended up getting the role on the sales side of the business. But so where did I start? The business that I'm in today, which is the private real estate syndications, right? I'm an advisor. I'm securities licensed with the Series 7, 24. And so I got right into this business. It's kind of confusing. I'm sorry. Today, I am so I'm a financial advisor today, right? My company is Perch Wealth. I represent clients at this point, right? So I help them allocate and invest. Prior to starting Perch Wealth and being an advisor, I spent 15 years on the investment syndication side of the business. So all of the investments that I'm recommending today to my clients, I was involved in manufacturing them, if you will, right? So from acquiring the real estate to doing the underwriting and the structuring and the due diligence and training and educating and then taking a product to market, I did all that for a long time, if that makes sense.
Sure.
Yeah.
So you graduated college what year?
2006.
2006. So we're almost 2025.
Almost 2025. Yeah. So what is it? 19 years. And I'm going on 19 years in this business. It's all real estate related. And I think we're going to touch on some of the items like Delaware Statutory Trusts or REITs or BDCs.
Sure.
I didn't know this industry existed, right? Again, you come out of college. I don't know what thought I was going to be a broker or a realtor. I had no idea, frankly. But this is an amazing market, and broadly speaking, you call it the alternative investment market. Alternative investments being anything that outside of your traditional investments like stocks, bonds, mutual funds, annuities. Where do you create more diversification in portfolios today? And I would argue a great place to be, and all the data supports it, is in alternative investments, primarily real estate or debt related structures, funds, products that are not traded, if you will. So they're illiquid for the most part. That's my world.
Yeah, and we're going to dig in there because I've never had anyone like you on the show, and I'm excited to find out more. So 2006, you hit the ground running. Okay, 9 years old, you kind of knew the bricks, you were exposed to all that. But let's just focus on the 19 years that after you got out of college.
Right.
So here you are, Ben, today. You're doing the alternative investment strategies, representing your clients, diversifying their wealth.
Right.
If you could go back in time, this question has two parts to it, and I kind of enjoy this. If you could go back 19 years ago and visit Ben getting out of college, what advice would you have given to yourself back then? And then the flip side, someone who's seeing this for the first time on this show, hearing about these strategies for the first time, or just real estate in general, what advice would you give the newbie starting out today? So let's first hit the Wayback Machine and visit Ben 19 years ago. What advice would you give to yourself?
From an investing perspective, I'll say two things. I wish I would have taken more advantage of the low interest rate environment, frankly, and acquired a lot more real estate, if you will. That's what I would have done for sure. I'd also say, for what it's worth, I should have gone out on my own sooner. I was in the investment syndication side of the business, in the corporate world, working for big organizations. And I was just skittish of going out on my own, I think, for too long. And so, especially for the young bucks, right, out there that are kind of looking to make some moves, you just got to pull the trigger. If you feel it and that's in your blood and you're an entrepreneur, you want to do your thing, I would go sooner than later. I know my dad and all our family friends used to tease me like, "What are you doing? You're still doing it." And so that that's a bit of advice on that front.
The number two, getting out sooner, you really nailed that because you identified that with an entrepreneurial spirit. And I think a lot of the people watching this show are going to resonate with that. Now, you mentioned the low interest investment to buy more. Like you and I know what that means, but what does that mean to the newbie who's seeing this? Like, well, why is low interest so important when you buy?
Right. Yeah. Leverage is an amazing to be able to take advantage or borrow money at very low interest rates or at a low cost is one of the most advantageous opportunities that we have in a capitalist society to build and grow wealth. And again, I'm 41 today. I was a young pup. I should have learned this. But to see the 3%, 4%, even 5% rates, historically speaking, are really low, right? And we're close to that, or I guess we're a little bit above that. That is just so powerful, right? So, I don't know if that answers your question, Brian, but if you can get, whenever debt is cheap, you take advantage of it, right? You can expand your portfolio significantly.
And this is good debt. I mean, some people hear the word debt and they get scared, but this is debt secured by real estate. And banks and lending institutions, financial lenders, they're okay putting a mortgage on real estate because it's a real property. Probably a lot more difficult to do this on a startup business or stocks or bonds or stuff like this. I don't know any banks who are going to write you a loan so you can go invest in the stock market.
Right.
Real estate, the leverage that you're talking about, and being able to control the asset for only putting, I mean, if it's owner occupied, you could get away with 3, 4, 5%.
Exactly. There you go. Yeah.
Yeah.
You buy $1 million building, you put down $50,000. Those that took advantage and did that, it's called in 2012 was kind of bad, 2011. But think you could have taken $500,000 and bought what is it, $10 million in real estate, and that real estate today has more than doubled. So you create not only a cash cow for yourself, right, rentals, but you're able to build a lot with very little. And to your point, Brian, it's all about good debt, right? Long-term fixed, so on and so forth.
Right, because these types of assets that we invest in actually produce cash. Right. It makes it an asset, not a liability.
Right. Yeah. And I'll tell you, this is part of why I didn't buy more real estate is because when I first got started, I initially bought an apartment building with a laundromat under it. And I had a lot of fun building the business. But in California, especially, you're guilty until proven innocent in the state of California. And I had so many issues with the tenants being ADA compliant. There's so many things that just popped up. It drove me mad. And so that's when I slowed down. Now, in retrospect, I should have just fought through it and done some more deep breathing to get through and continue to buy. But, it is what it is. But yeah, for again, those folks that are just getting started, getting out there, you have to look at where you're buying, right? And be in California, it's a great market. People have made lots of money, politically, legislatively, it's tough, and you just need to be aware of those things.
Yeah, you absolutely need to know your tenant landlord laws. I mean, I always think of the movie Pacific Heights with
yes.
Ever thinking about buying a rental property, should watch that movie first.
Yeah, that's right.
I can't help myself. If I even watch that movie today, I find myself screaming at the TV saying, "Don't do that! Get out of the apartment! Don't open that door!" Right? I mean, all this stuff, and just to affirm that I'm also crazy. I do this in Massachusetts and California, which have
Yeah. Two of the bad ones. Yeah. But
well,
yeah.
eh,
Give and take, right? There's ups and downs.
yeah, I'll say they're the hardest ones,
Right.
but again, if you know the rules, the regulations, you color in the lines, you're going to be okay. Just do it right.
Agreed.
So these newbie investors, what other advice would you give for them starting out today?
Newbie investors. I mean, the lesson I've always and I appreciate this so much and value so much. I mean, just live below your means, obviously, and period. And invest, just be disciplined in investing early and sooner. That's what my parents always reiterated to me. Doesn't matter how much you're investing, just start investing early and just tuck it away. Create your little buckets of investments. You want to diversify, so you got your 401k or IRA. You got your hopefully some real estate, your your stocks and bonds, and diversification. Live below your means and invest early. That would be absolutely.
You also mentioned at the beginning of that was look at where you're buying. And I get this question all the time. People will ask, what's the best market to invest in?
Right.
And
Right.
whoever you ask is going to have a different answer.
Right.
What I say, the answer to that is, what's the market you know the best? So that would be the best market for you to invest in. I mean, California probably way better than I have. I've only been in that state less than 5 years. So your experience and track record in California, I mean, I would ask you questions before I would try to answer them myself. But Massachusetts, on the other side of it, Mass General Law 186, subsection 15B, I can wake up in the middle of the night spouting out chapter and verse on what we should and shouldn't do there. So, yeah,
Right.
and, look at where you're buying. What is the best market to invest in? The market you know the best.
Right. I would. Yeah. Of course.
So, I'm curious,
Yeah.
where are the markets you're investing in right now?
Sure. Yeah. So the market. So from a market, without going into sector yet, when you talk about what sectors I'd be investing in, but for just look, real estate values. They're fully aligned and predicated upon job and population growth. Right. I mean, broadly speaking, you want to go after where job and population growth is. And so today, with like affordability at an all-time low, where do you see this migration? You see it. You've seen it in the South and the South, South and the Southwest. Now you're seeing it in the Upper Midwest. So that's what I'm looking at today. I'm looking at affordability, job growth, and population growth. So I'm not. Of course, I'm not against any market. There's an opportunity everywhere, but broadly speaking, that's what I'm looking at. Long term, that's what's gonna, wither the storm and also create long term value.
And you have your track record, so when you pick up the phone, you have credibility. You're going to be able to build those teams, get those alliances in the markets, and that takes time. That's not something someone hearing this for the first time and say, "Okay, I'm going to jump into the Southwest and build my team." It's like, well, who are you?
Right.
I mean, since you were 9 years old, you understand this game. You talk the talk, walk the walk.
Right.
Quack like a duck, it's a duck.
Yeah. No, it's yeah.
So, just curious, I mean, there's so much I want to ask you about the different things on your list here, but what is the asset class that you're probably mostly invested in today? And I know there's a whole candy box there, but
Yeah.
what's the biggest slice of that?
Yeah, I'll give you time. And I'll bring out one of the. I'll say if there's 4 food groups that we allocate to, because we diversify quite a bit, right? Believe it or not, I don't know. Most folks aren't aware of this, but oil and gas mineral rights or royalties, love them. I love them. Just got on those a few years ago. I think it's a great play. I like multifamily today. I really do. Broadly speaking, multifamily is soft today. There's been a tremendous amount of new inventory delivered to the country, and that's a function of those low interest rates, right? Low interest rate environment. The developers went wild. They were borrowing and building and borrowing and building, making a ton of money. And so this pipeline of inventory built up over 10 years. And a lot of that, the waves of the inventory were delivered in 2022, 2023, and then this year, 2024. So that's created downward pressure on rents and occupancy in many markets throughout the country. But now with higher interest rates and the construction costs, the pipeline of new developments going forward is way low. And so once the existing excess inventory today gets gobbled up, if you will, the pipeline of new developments is way down. It's going to be a landlord's market again, right? Demand is going to outstrip supply, whereas today supply is kind of overtaking demand. That's a long story, but
Yeah.
well, oil and gas, mineral rights, multifamily, I like a lot. And to your point, multifamily has been a winner throughout history. To some extent, industrial to some extent, right? Certain markets and healthcare, medical office, high quality. And then even the last one I'll say is even triple net properties, right? One single tenant, as long as you have strong credit, a good lease term. In this environment, I don't know how you feel, Brian. I'm pretty bearish. And I was horribly bearish until the new administration got in, like him or hate him. I think he's good for our country. I think he's bringing confidence back. But I don't think we've seen the low that we should see after going through COVID in these past years. So I'm very cautious with recommendations. So I always want to be investing in defensive, resilient investment strategies that are poised to perform in both good and bad market cycles, right? My clients are older. They're 60, 70, 80, 90. They've made their money. They want to protect it. And that's what I do.
Yeah, so mineral rights, multifamily, industrial, healthcare, and triple net leases, which are your commercial investments, stuff like that.
Right.
Yeah, and I got a few comments I want to just add here. When I started the show about a year and a half ago, I think we were down 5 million dwelling units in this country. And you mentioned there's been inventory coming in. And I think that number is more like around 4 million now. So we're still shy before we can hit equilibrium. And this, I believe, I agree with you that we should have seen a low a long time ago, but I think it's artificially being inflated by the lack of inventory that's out there.
Yep.
So we're still going to see, I'm not thinking that we're going to see the rent increases we've seen over the past 4 years.
Right.
But I don't see the rents going down yet.
Right. No. For you personally?
Yeah, in the market
Okay,
I'm involved in.
yeah.
I got to take that back. There's been a couple that we've seen a dip, like in the larger units, like 3-4 bedrooms, stuff like that. We've seen a slight dip down. But your 1-2 bedrooms are resilient and still, it's funny. A 3-4 bedroom is real close to a 2-bedroom rent in the markets I'm in right now, which, I would tell my investors all day long, buy a full apartment building with 2 bedrooms in it.
Right.
Because you get that couple in there, maybe they have an office or something like that.
Right.
Yeah, I'm not going to get into anything that could be deemed discriminatory on this podcast. So,
Right. Yeah, absolutely.
Yeah, so that was some really good stuff. Here I ask about deals you've done, and I may turn the tables over to you to have you explain some of the different products or services
Yep.
that Perch Wealth is actually providing for your clients. So typically I ask, what was the best deal you've ever done? What type of property was it? How did you find it? And how did you finance it? So if you want, we can go down that road, but I really want to allow you some time to, I got to know about the 1031 exchange
Yep.
with the Delaware Statutory Trust and how those fit together. So
Sure. Yeah.
it's
We
your,
jump. Yeah. I'll take. We're jumping around a lot. I hope hopefully it flows for the audience. But and that's my fault, by the way.
no, you're good.
The best investments I ever made, it was multifamily in Florida, and I started investing in 2009. I probably got into 7 different projects, and I wasn't the only guy. It was me and a bunch of other people, and these were big deals. These are 350 unit, 400 unit, and I'll tell you, that was deep. We got incredibly cheap debt, and I mean, tripled our investments at least, and we would refinance, and just you said, refinancing, taking out cash. And we had all our money back within, I want to say, 5 years of investing. And then we sold them in, year 8 or something. They were amazing. Just the right time, the right place. Florida, low interest rates, and multifamily at that time was oversaturated, right? That's right after the crash, 2008. So those were unbelievable. In terms of, so what I do, again, I'm a financial advisor. I'm not your traditional financial advisor that's recommending stocks, bonds, mutual funds, annuities. I'm not managing stock portfolios. I help accredited or high net worth investors with diversify their capital or their wealth in private real estate, whether it be funds or 1031 exchanges. Most of our business today is on the 1031 exchange front. And for those that may not be familiar with 1031 exchanges, it's the most powerful code in the tax code, in my opinion. It's been around for 100 years. A 1031 exchange allows investment property owners to defer paying taxes when they sell their property, defer paying taxes as long as they take the proceeds from sale and reinvest into other investment property. It's one of the biggest advantages for real estate investors. There's so many there's guidelines and parameters for a 1031 exchange. We don't have time unless you want me to go into it. But they're not easy to it's not easy to just sell and then buy another property in some cases within the timeline set forth, right, by the IRS. And so the 1031 exchange opportunities I provide my clients are very unique. It's definitely a niche business. They are DSTs, Delaware Statutory Trusts, right? So 1031 exchange is in the tax code, right? It allows you to defer taxes selling and replacing an investment property. The DST is a structure or vehicle that satisfies a 1031. So the Delaware Statutory Trust, they were created in the 80s. They weren't set up for 1031 purposes at that time, but it's a structure or an entity or trust where you have one trustee that manages the trust on behalf of up to 499 beneficial owners, right? So you apply this trust to real estate, it creates a situation where fractionalized ownership. So you can have a lot of investors come in and invest, own undivided interest in the trust that owns XYZ properties, and it's still treated as real property ownership. So in 2004, this fractionalized ownership structure was validated by the IRS. They said, yes, this is real property. This is considered real property, and therefore eligible to satisfy 1031 exchanges. Right. So 2004, that's when the DSTs were born. Right, and they've grown in popularity ever since. Let me give you an example. A DST could be $100 million multifamily project in Dallas, Texas. Right, you have what we'll call a sponsor, which is a big real estate company. Let's call, you're on the East Coast, Cantor Fitzgerald, right? I used to work with Cantor Fitzgerald. They go out, they buy this property, $100 million, they strike a check, they take it down. They get if there's financing, they get the debt on it. They hire third-party property management, they provide the asset management, they monitor and take care of everything. They cut checks, monthly, but basically it's a turnkey 1031 exchange replacement property solution. So you, Brian, you say, look, I'm going to sell my property. I'm selling my property, and man, I don't want to manage anymore. I'm tired of management, like me quitting 10 years ago when I should. But I'm tired of managing. What else out there? If I sell, I don't want to pay tax, so I'm going to do a 1031 exchange. What is it going to do for me buying another property? I have to worry about that now. What else is out there? And these Delaware Statutory Trusts are. So they're institutional quality real estate managed by big real estate companies that are turnkey. So you sell your property, you can exchange right into that. Like in 5 days, you're closed. Your income's producing, starts accruing immediately. You're getting income and done.
So I think I just had a light bulb moment here. So I'm going to take one of my assets.
Sure.
I want to do a 1031 exchange. So I go through a fiduciary, someone like yourself, who does the 1031 exchange, and say, hey, I got this property, I want to do a 1031 exchange. I'm able to sell that asset and put the proceeds into the DST.
Yes, sir. And it gets better, my friend. It gets better. Way better.
It's a light drop moment.
Way better. So DSTs, so think about, so they're quick. You don't have to worry about the urgency associated with the timelines, which, for your audience, check out the timelines, or we can talk about it on a later clip. But these properties are acquired, they're owned, they're stabilized, they're income producing. You can slide right in. Because they're up to 499 investors, the minimums are only $100,000, right? So think about this. I take little Mrs. Smith, who's dependent upon this income, or this is like her biggest asset in LA. She sells a 3-unit apartment building for $3 million. What is Mrs. Smith? She's not, she doesn't have the time, energy, expertise, or desire to be buying real estate, but she can't pay tax. What is she going to do? Well, I could take that $3 million and I could spread it across, in theory, 20 different DSTs. I wouldn't do that many, but I could take little Mrs. Smith's money and I could put $300,000 into this multifamily in Dallas, Texas, $300,000 into a self-storage in Raleigh, North Carolina, $300,000 into a medical office building in Florida by the biggest, managed by big. So it's an amazing vehicle that is widely unknown, even, to 90, you're a real estate guy, 95% of real estate professionals, attorneys, CPAs, they don't know it exists. And I'll say one last thing and I'll stop. And you think about demographics today, right? The DSTs were created in 2004. They've grown in popularity. They'll continue to grow. The reason for it is demographics, right? You look at the baby boomers, the seniors that control the majority of wealth in the world today. And a lot of that wealth's in private real estate that they've acquired and aggregated and managed for 20 to 50 years. These folks are tired. They're tired. They don't want to manage it anymore. And then you take it one step farther. When you look at what they're earning today, they bought real estate 20, 30, 40 years ago. They're earning very little income. I mean, 1 to 3% on current values today. Most of them are fully depreciated, right? So they're not sheltering any more income. So not only can we could improve their life by removing the active management component, shifting to DSTs, deferring the tax. Most times we're able to increase the income. I mean, it just goes on. They're beautiful. It's amazing product.
So that's why. Yeah, this show is gold. So I'm going to ask the hard question, right? So Mrs. Smith, she puts her $3 million in. You diversify it from the 5 different buckets that you're investing in. Okay, Mrs. Smith is going to have a life event and needs to get out of one of these. What does it look like to exit a DST?
Great question. So, I mean, short answer and is these are illiquid, right? So this is, we talk about the cons and pros, right? It sounds like a dream. I'm getting all excited. There are downsides or limitations or structural issues for some investors. DSTs, they're illiquid, right? So it's not an investment. If you buy your own property and you want to sell it, you can sell it anytime you want. When you invest in a DST, you're giving up full control to the manager. In my example, would be Cantor Fitzgerald. And so typically, and per the prospectus, it's a 5 to 7 year hold, right? It could sell sooner, could sell a little bit later, but that's kind of that time horizon, 5 to 7, right? So if investors need capital or may need capital, I'd say take it on the front end, right? Or don't do it at all, if that makes sense. So illiquidity is an issue for some.
Okay, so Mrs. Smith, she needs $500,000 to live for the next 5 to 7 years, right? So she's that's called the boot on a 1031 exchange. You're gonna pay tax on the 500. I don't know what California would do, but maybe she gets 250 out of that.
Right.
That's enough to get her to the end of that time period. Yes. So then the DSTs sell, and that's when the investors hit their taxable event.
Great question. So when the DSTs sell, you invest in 5 different DSTs. Of course, they're going to sell at different times. They're not all going to sell at once. So you have to keep that in mind too. When they sell, let's say that one in multifamily in Dallas sells after 5 years, they sell it for $120 million. So they made 20%. So you're going to get your principal back plus your pro rata share of the profit, and those funds are 1031 exchange eligible again. So you may say, hey, I love these DSTs. I'm going to go right back in. Or you say, you know what? I'm going to go buy my own property down the street. So you're not tied to the DST forever. When it sells, you can do another exchange or you cash out and pay tax.
So I can continue to ride the bus. If I've got 5 different bus tickets, I can cash out 1 bus ticket for any life event that I might want to do. Or if I want to control a property again and I want to roll up my sleeves and do whatever I want to do again, I could take one of those bus tickets, turn it into my own. That is beautiful.
And Brian, I have to say this, you'll appreciate this too. The debt, these DSTs, some of them are debt free, some of them are 60% levered. And in 1031 exchange world, for the audience, if you have debt on your property that you sold, you need to assume equal to, if not more, debt on the property that you buy, right? So debt's a big component. So on the DSTs, for those that are leveraged, the sponsor, the Cantor Fitzgeralds, if you will, they secure the debt. They're liable for the debt, but the investors benefit from the debt. So Brian, let's say you sell a $1 million property, you have 500,000 of debt, 500,000 of equity, right? 50% leverage. You sell it, you pay off your first mortgage, 500,000 goes to that qualified intermediary, and you need to buy $1 million with that 500,000 of equity. You can exchange into 1 or more DSTs as long as the leverage comes out 50%, right? And so you walk right into it. You don't need to get pre-approved. It's non-recourse, nothing. You never see it again, and it satisfies your exchange.
So my question to you, when I get to that point and I have this event, it's like, okay, what DSTs do you have that have this much debt, and I can put on those?
Absolutely, right.
Or what DSTs do you have that fit this debt model, and I can jump in?
Absolutely, and that's what we do. And drawing upon the value that I bring to my clients is that, again, there's 100 different DSTs in the market. There's a lot of stuff. And the market itself is very fragmented. There's really no transparency. There's not a centralized platform that says, hey, Brian, this Moody's and S&P gave this DST a plus, or this a plus, or this. It doesn't exist. So they all look good for an outsider. They're not all good. And so, again, going back to where we started, I was buying the real estate, building these things for big companies. I mean, I underwrote thousands of them. I know the sponsor companies. I know the fee structures. I know all the variables that come into play. And so the value that I bring to the table is I'm able to mitigate risk, right? And there's very few in the country that Actually, I don't think there's anybody that has my experience as an advisor today.
Man, I'm so glad you signed up for the show. This has been
Yeah,
tremendous. So
thank you.
we talked about the 1031 exchanges, and if somebody wants to find out more of those, I would say hit Google and find out more about
Right.
that. There's
Yeah.
your traditional 1031s, there's reverse exchanges, all kinds of stuff that I'm not going to jump in on that saddle right now. The DSTs, oh my God. I'm going to be like staring at the ceiling tonight in my bed, just like the wheels are going to be turning now.
It's
So,
exciting. Yeah.
2, 3, 4, 5. You got like 7 other tools in your box here. So, structured real estate investments, that's kind of what we're talking about right here.
Yeah, I won't go into each of the other ones, and I'll tell you, 90% of our business is on the 1031 exchange front with the DSTs or TICs. The other again, the other syndications like REITs or there's private real estate funds. Again, think about all the going back to 2000, the traditional portfolio model of what 60% equities, 40% bonds was broke in 2008, right? So like the people that saved and they had 40 in bonds and 60 in equities and they had real estate, they had this, that 2008 happened, they got wiped out. And so you start thinking, okay, well, who did well, right? Who did well during that time? And of course, it's the endowments, it's the institutions. You go, wow, okay, what were those guys investing in? 30, 40, 50% were in alternative investments, right? They didn't get clobbered by the market, the fluctuations. They didn't have debt getting pulled. They were in private alternative investment funds. And so, bring it back to your question, for the folks, typically the way it goes down is I do an exchange for them. And they say, okay, Ben, I got this cash or, what else can I do to diversify? And I can introduce, like, whether it be a REIT or an oil and gas energy deal or a tax mitigation strategy. I'm kind of that 20% sliver for these investors that have no exposure, that are worried about today. They don't want to lose everything again, right? They came back from 2008. What do I do to limit my downside? And I would say this.
Wow. This is fun.
Yeah, it's fun. I love it. I hope it makes sense to the audience, Brian. That's it. I know it's jumping around,
Well,
but
I interview people all the way from starting with their first multis. We've had a couple billionaires on the show, and
yeah,
we'll put this out there. And, definitely. And again, I mean, all of our guests, you're going to get the raw footage. So if you want to do SEO or whatever, you'll get the final cuts
yeah.
on that. Happy,
And we can
happy.
do a round two. Hopefully you get feedback. If there's enough interest, we can dig deeper. Some of the
Wow.
stuff.
So yeah, we're doing good on time, and I want to respect your time.
Sure.
So here we are. What is the biggest hurdle you've had to overcome as a real estate investor?
Me personally, biggest hurdle I've had to overcome.
And
Um,
how did you solve it?
I would go back to the biggest problem I had. It's probably back to that. We're back at the old laundromat. I mean, that was bad. I mean, and the solution. I mean, I was dealing with the tenants. The ADA compliance thing came in. The termites. It was a mess. And the solution, which again, in retrospect, I don't know if it was the right solution. I sold it. But that's honestly the biggest. That's the biggest challenge I've ever had, like direct with real estate investment. Because since then, most of my investing are in syndications or with partners that are running the show. I don't want to do. I don't have time for it. So I'd rather lose a little bit on top, fees or their promote, and not have to deal with those types of issues. It's just I don't have the time to take care of it.
Yeah, and I mean, I still suffer that brain damage because I'm involved with property management. And okay, I'm good at it. I like people, I like to talk to people, and I ask hopefully the right questions to solve the problem. Really good stuff. Okay, so we're gonna keep moving along here. You're a smart guy. I'm sure your bookshelf is very interesting. Was there a book in your investing career that made a difference for you as a real estate investor?
In my investing career. Well, first of all, my shelf is not stacked. I read so much all day. I don't read, but I'm trying to think what was most impactful to me.
I mean, a book, a podcast, a show,
Yeah,
whatever. It's
yeah.
something that, put the fire in your belly.
I mean, this is just going back to, and it goes back to my dad again, the roots. Like Rich Dad Poor Dad was pretty powerful. I don't know, basic uh, um, book, but it definitely lays the foundation or sets the groundwork for success. There's no doubt. Other than that, my friend, I mean, honestly, it's I read the Bible. It's yeah, I'm reading documents all day long. I'm sure there's other podcasts. I love podcasts. I can't think of it right now, bro.
Well, to the Bible, Proverbs has some of the best business advice in there. And then
Amen.
Ecclesiastes has some of the best wisdom in there. I mean, Solomon was no dumb cookie. So,
Amen.
yeah, very interesting. So, is there any other book or resource that you would throw
That
out?
I recommend.
Yeah.
Let's see.
What kind of stuff do you like to read?
Yeah, I mean, political, financial. I mean, I'm on. I mean, for like this is one. If you go to like for the audience, if you want to learn a little bit about our space, you go to like DIYer. DIYer is like an alternative platform that like will introduce you to the sponsors and the investments and give you a little insight into the world that I operate in.
What what is DIYer? Is it a podcast, website?
Yeah. Oh no, it's a website.
It's a website.
It's a website. Yeah, so I mean, I would check that out. I'm sorry, Brian. I've been blank.
No, you don't have to
I
apologize.
just read. Look, I read PPMs all day, and I'm going through pro formas and reading legal jargon. And then you know what it is for me. I talk to so many people all day. I'm talking to brokers. I'm talking to lenders. I'm talking to investors. I'm talking to sponsors, analysts. I mean, that is the best information I get, right? When I talk to Cantor Fitzgerald, they're multifamily guys, like these are the guys. Or I'm talking to, Madison Capital, their lending team. That's really a big source of my information. It's ground level.
Current.
It's pretty good.
Meet,
Current.
yeah. Meet
on the beat, right?
Yeah. Wow. Really good stuff. I'm definitely going to check that out because I've got a lot to learn. I mean, I love doing these shows where I have more questions at the end of the show than when I started the show.
Sure, there's never enough time.
I'm really enjoying what you're bringing to the table. So you've hit that. So what's next for you at Perch Wealth, and what are you doing today?
Right. Well, so I have a business partner, Ehud Gersten. He's a real estate attorney, or former real estate attorney. We have 11 advisors on our team now, so we're nationwide, and and so we built the company. What's next for Perch Wealth? We're going to continue to build. For me personally, I'm trying to delegate. I'm trying to delegate to grow. Right? We can go into another segment about small businesses and growing and the challenges there. But we've grown so fast, so quick. That's my next chapter: is efficiency, logistics, and of course, I mean it's all about the client. So improving the client experience whenever possible.
I hear your phone chiming on you, so I want to be respectful.
Oh, okay. Yeah,
wrapped
sure.
up here. So here's a question that's not on the list, and I always love this one.
Sure.
What question should I have asked you today that I didn't ask?
Oh man, there's so many questions. What question should you have asked? Related to our business. Well, you could have asked me about pickleball. You didn't ask. I love pickleball. Look, Brian. There's so much in what we just talked about. We just touched on the surface layer. 721 upreats, right? Those are big. Write that down. 721 upreats. That's related to our topics we talked about. I would say 721 upreats. How come you didn't ask me about 721 upreats, Brian?
I didn't know they existed.
I know.
So if you could give me a 30,000-foot overview, what is a 721 upreat?
Okay, so 721 upreat, it's also in the tax code. And basically it allows like a REIT, a real estate investment trust, to buy investment property in lieu of paying out cash proceeds to the seller of that investment property. The seller can take shares of the underlying REIT on a tax deferred basis, right? So let's just say, Brian, you own a nice multifamily property or a triple net property, and NNN, Realty Income, comes down and says, hey, I want to buy your property, Brian. And you said, great, I want to sell it. Great price. They come, Brian, we'll pay you this cash. Or if you want, you could just take, you could own shares of my $5 billion REIT. And that's done on a tax-deferred basis. What does that do for you? Well, first of all, you're out of active management, if you will. You go from owning one property to hundreds or thousands of properties, right? More mitigating risk significantly, right? And getting that income stream in perpetuity, frankly, right? So it's a path of converting from direct real estate ownership into a REIT. You can't do future exchanges if you go into a REIT. But again, in my world, these folks, my clients, they've made their money. They're looking to protect it. And it's a dream for them. So wait a minute. I can go from I can be in a $5-6 billion REIT. It's a no-brainer for many of them.
I love asking the question that I didn't ask. So you've done a great job. If our listeners want to get in touch with you, how would you like them to reach out to you? Email, website?
Yeah.
How should they find you?
Yeah, absolutely. I want to give you out my cell, and you may think I'm crazy, but this works every time. People call, and I love it. 818 area code 269-4972. And then my email is bcarmona, that's CARMONA, @perchwealth.com. bcarmona, perchwealth.com.
And of course, the website is perchwealth.com.
Yeah, go on there. We have lots of advisors, but if you call me, we will absolutely get back to you quickly.
Perfect. So, any parting words before we wrap up this episode, Ben?
No, Brian, really appreciate your time. I enjoyed, meeting you and speaking to you, and thank you for having me on. And hopefully, the audience gets some value out of our discussion.
Did you have fun?
I absolutely did, and I love the red glasses. Right? Yeah, the Christmas spirit continued. Yes, I had a lot of fun. Thank you so much.
All right. Well, ladies and gentlemen, here we are at the end of another episode of the Why Not Real Estate Podcast. This is our guest, Mr. Benjamin Carmona, and your host, Brian Lucier, signing off. And we'll see you all on the next one.